Well, the transmission mechanism is obviously oil prices. So obviously, oil being in the bear market, receding more than 20% since the high of this year, that's the transmission that we see. And whether that will translate into terms of tighter liquidity in the banking system is another question. Spreads versus US LIBOR will probably widen if oil prices stay at these levels. And perhaps continued fiscal austerity that in our key markets, for example, for Saudi, we still expect about 6% deficit. And over time, this needs to be reduced to about zero by 2023. Obviously, it's over a measured time frame, but in line with about 2% of GDP headwind for the next few years. So that's not really changing in my view. So we're going to continue to see quite tepid growth overall for the GCC as a whole. And obviously, we're still comfortable with around 60 to 70 handle. If we drop below the 60, it becomes much more tight, and there might be new measures. For example, IMF has alluded to the fact that maybe the VAT will need to go to 10% over time.
Okay, so in this environment, how do you find opportunities amid trade tensions, the currency war, and also regional issues as well? How do you find the best buys?
Well, in the banking space, we've become now underweight on the Saudi banks because, in fact, the results we've been so far very good because, in fact, it was a slow adjustment to the higher interest rate environment that we actually saw up to now, and we're obviously going to in reverse. So to show you the magnitude of that sensitivity, every 25 basis points is about, on a structural level, on return on equity is about 0.5% for Qatar, to about 0.8% for UE. But for the Saudi banks, we're talking about 1.2 to even 1.6% return on equity impact. So obviously, we're talking about maybe 100 basis point rate cut in the US. So that will have a material impact on the return on equities going forward. So that's why we're underweight on Saudi, particularly because the valuations have been lifted to quite high levels because of index inclusions. UE still actually a lot is priced in. A return on equity contraction is more than priced in. And there's self-help as well going on. So we see a huge efficiency drive from the consolidation. So we think there's an interesting play. You can play M&A angle because we expect one of the players in the UAE to be bought by First Abu Dhabi Bank, for example. So there's enough plays to kind of keep exposure to the UAE banks, in my view. But we rotated out of the banks and we rotated into the healthcare space. Healthcare had a very difficult year last year because of expat exodus. That's been slowing down in Saudi, so that's been picking up that. Insurance, healthcare insurance, the big players, Bupa and Townie, are doing really well, particularly because the smaller players find it very difficult to compete. So we took a position in there. And education, we moved back to education because there was a dislocated valuation as well, we think is a secular growth sector as well. So there's enough things to play, but it's a little bit outside the key index. Particularly outside the MSCI index.
Okay, so I think this is interesting and there's a lot to unpack there. Essentially, the Fed cuts interest rates. As a result, GCC banks around here also decide to follow suit. That's going to directly translate into bank earnings, ROEs, NIMs as well. Does that mean that banking as a sector isn't necessarily going to show the same returns that we've seen in the past long term, or are you still broadly optimistic short term about the banks? Just help me understand that a little bit more.
Yeah, so obviously when rates go lower, the sensitivity in the short term is quite high for Saudi. And the reason is that a lot of the loans they provide are on floating basis, particularly the corporate loans, and a little bit of the mortgages as well. So that adjusts very quickly. The Saudi market is quite unique because there's a lot of current accounts. So it's about 55% of the total deposit base are current accounts. And they're not so leveraged. So the equity component is quite heavy. So in fact, you can't cut much on the funding side, whilst on the asset side, you start seeing that effect quite rapidly. So the positive effect that we saw so far will completely reverse and probably compensate more than what we've seen in terms of earnings momentum going forward. So that's a major factor. Having said that, return on equities, if you compare to Europe, I mean, Europe is trading around 6% return on equity.
Right.
We're in the 12, 13, 14% handle for the GCC. And we're going to still remain double digits unless the interest rates will go to zero, obviously. So it's still an attractive venue. If you look at, look at structural returns, for example, the sector, you look at dividend yields, you look at the structural growth and book value, we're still talking about double digits. So being a long-term investor will still make double digits, and obviously in Europe that's quite difficult to achieve.
Hey Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.